Welcome back to the channel, and in today's lesson we are breaking down some of the most important ICT concepts you need to understand when reading price action. We'll cover PDREs like order blocks, fair value gaps, inverse fair value gaps, buy side liquidity, sell side liquidity, and most importantly how liquidity gets activated in bullish and bearish scenarios. Now the goal isn't to memorize these terms, but the goal is to understand how they work together. So let's start with PDREs. Now what the PD in PDREs simply stands for is premium and discount. PDREs are areas on the chart where we expect price to potentially react or deliver from. Now some common PDREs include order blocks, fair value gaps, breaker block, mitigation blocks, and rejection blocks. But here is the most important part. We don't trade a PDRE simply because price touches it. We need more context, right? Now we want to know where liquidity is, what price has already done, or whether they are in a premium or discount, right? Now the PDRE is just the location. The market narrative determines whether the location actually matters, right? Now onto our first PDRE, we are going to be talking about the order block first. Now, by definition, an order block is generally the last opposing candlestick before a significant displacement, right? So let's use that. Now, there are two types of order blocks, of course. We can only buy or sell, so there's only a bullish scenario and there's only a bearish scenario. So now let's check for the bearish scenario. So in the bearish scenario, according to the definition, you want to see the last opposing candlestick before a significant displacement. So that last opposing candlestick can be a bearish candlestick, and that significant displacement can be a bullish candlestick. So let's make this green, scratch that. The last significant can be a bullish. Let's make this green. Then the displacement opposing that particular candlestick can be bearish, right? Now this bearish candlestick becomes our order block because it contributed to this particular bearish move, right? Or it's the last opposing candlestick before this bearish move. So this becomes our order block. Now, a bullish order block will just be the vice versa of this. So the last opposing candlestick, which is what's a bearish candlestick, before a displacement in the opposing direction, which is a bullish candlestick. And because this particular candlestick is contributing to a bullish move, this becomes an order. Now, one thing you need to remember is that not every candle is an order block worth trading, right? We want to see displacement and context behind that particular displacement. For example, if price takes a sell side liquidity, displaces higher, and leaves behind a bullish order block, the order block becomes more meaningful, right? We don't just trade a candlestick, we are trading the story behind the candlestick. Now let's get a real chart illustration of what an order block should look like and act like. So let's go to our chart so that explains what I'm talking about in further detail. Now I want to see another block that was used. Okay, perfect order block. So do you see this was the last candlestick before this opposing move? So the last bearish candlestick before this bullish engulfing move in the opposite direction. So this becomes our order block. Now when we are drawing order blocks, we draw the last candlestick before the opposing move, and you don't include the wicks, right? So the wicks are just telling the story, right? The wicks are just telling you a story, but the body is the real deal. So this is another block. You can see how price expanded from this order block, retrace back into this order block, then use it as a reason to target this particular buy side liquidity once more. So that's how order blocks are used. Because this is a bullish order block and is contributing to a bullish move, price retraces back into it and continues that particular bullish move. Now let's get the same scenario for a bearish one. Now there's a bearish one right here. So there's the last opposing candlestick before bullish move, right? So we mark out this bearish order block. Now why is it a bearish order block? Because it's contributing to a bearish move. So you can see how price goes into a more discounted area, comes back to premium using that bearish order block and use it as a reason to get back to these lows. So that's simply how order blocks are used. Now one more effective way you can use order blocks is also employing the premium and discount narrative. So now let's study this particular expansion right from this high all the way to this low is one single expansion. So let's mark it out with our Fibonacci from the high to the low. Now what the Fibonacci has done here is that it has demarcated this whole range into two levels, which is our premium and discount. Now what PDRAs do we find in our discount? Do you see we are having this particular order block in our premium? We are having this particular order block in our premium. So let's mark it out. Because we have a bearish PDRA in a premium zone, we know that a premium zone is where it's highly probable for price to sell from. So we have two confluences, a premium zone, secondly another block, right? So right from there you can take your sales from here, targeting something lower. So that's one confluence you can use to select a good PDRA. Now PDRAs can form anywhere, but as I said in the previous explanation, is the location. The location makes it more potent or highly probable to support a good trade, right? So that's how it works. Now let's get that same example for a bullish scenario. Okay, I think I have a bullish scenario here. So let's mark this expansion. Right from this low to this high, it's a single expansion, right? So this is what I'm talking about. I'm talking about this low and I'm talking about this high. Now let's mark it out real quick. So we have a move from this low all the way to this high. Now do you see how price reverses back into a discount before going higher? But I didn't just reverse to any point in a discount. It didn't just retrace to any point in a discount. It retraced into an order block. Where's our order block? You see this was the last bearish candlestick before this impulsive move in the opposite direction. So that becomes our order block. Let's draw it out like this. So just like that, we can have a trade from here higher. So you can have a trade like this. Very, very simple trade. Then you can target something going higher. Now this something going higher is what we call buy side liquidity. I'll be explaining it, so stay tuned in. Alright, so that's all for order blocks and how they are used. Now we'll go into detail more in future videos, but that's how they are used basically, right? Now the second PDRA we are going to be talking about is the fair value gap, in short FVG, right? Now an FVG is an imbalance created by an aggressive displacement. So an aggressive displacement can look like this, like one-sided displacement, right? And obviously there will be multiple candlesticks here that also validates that particular displacement. Now in a bullish move, price can leave an imbalance between candle 1 and candle 3. So let me get to that particular illustration here. So we have candle 1. Let's just duplicate this. We have candle 2 and candle 3, right? Now let's draw their wicks, of course. Let's draw their wicks here. So we have wick here, and a wick here. So now let's label 1, 2, 3 with my text too. So we have 1 here. This is 1. Then this is 2. Then this is 3. So what you want to see from candlestick 1 and 3 is that their wicks don't overlap. So you can see the lower wick of candle A and the upper wick of candlestick 3 don't overlap. So essentially we have what we call a fair value gap. So this is what a fair value gap looks like. Let me make it a different color so that we understand. Now how do we identify or how do we validate whether this is what a bullish fair value gap or a bearish fair value gap? Is simply the direction they are forming in. So because this was a bearish aggressive displacement and we created an imbalance between candlestick A and 3, this becomes a bearish fair value gap. Now it doesn't matter what type of candlesticks that help form this bearish fair value gap, as long as it's contributing to a bearish move, it's called a bearish fair value gap, right? Now the vice versa, I'm going to invert my chart as usual. So because this particular move is what contributing to a bullish directional displacement, is going to be called a bullish fair value gap. So that's how fair value gaps look like. Now we are going to be talking about how they work shortly. Now the market may later retrace into that imbalance to rebalance before continuing. So that in simple terms is what we call retracements and expansions after retracements. This is why the first video I posted here is very important. So it's very important to check that out before you move here, or else you'll be confused. What that means is that after this expansion, we are to expect towards a retracement before another expansion. So they can retrace into this bearish fair value gap before it's expanding lower. Now, to prove that this is really using the loss of premium and discounts, let's mark our Fibonacci from this particular high to this low. Now, do you see how this fair value gap finds itself in a premium? So price tends to retrace into it, and that's the highest probable area we can get a good selling opportunity from. So hence we go lower from there. Now for the bullish example, invert the chart, same narrative, expansion higher, retracement into a discount. What is this? A bullish PDRE, a bullish fair value gap to be specific. So price moves from that area to go higher. Now let's go to the actual chart and see how fair value gaps are used in trades like that. Let's get an example. Okay, so I think we have an example here. Yeah, very good example. So let's mark from this particular low all the way to this high as one expansion, right? So we are marking from this low to this high as an expansion. Now we have premium and discount, and we know that the range is bullish, and also we know that they can be bullish for a very long time. They'll have to retrace into a discount before continuing higher. Now do you see how price retraces into this tiny fair value gap, and it also happens to be a bullish fair value gap? So one thing you should always keep at the back of your head is that if you want to look at a bullish move, you want to look at a bullish PDRA supporting that move, and the location of that bullish PDRA also makes it more valid. Now if you get a bullish fair value gap in a discounted price point, a discounted price zone, price can retrace into it, and that will be a high probability buy into another premium zone. What that means is that I'm taking my buys from this fair value gap. Let's say my stop loss is below the fair value gap slow. So we have candlestick A, B, and C. So there's a fair value gap slow. So 1, 2, 3. This one and this doesn't overlap. So hence a fair value gap. So we can take our trade from a discount bullish fair value gap back into the area. So that's what it looks like. Now let's get a bearish example too, so that we understand that it doesn't work only in one side, right? Let's get another example. Okay, let's use this example. Audio was already mitigated. So let's take this as a whole expansion, right? From this high to this low is the expansion we have to look at. So now from this high all the way to this low is one expansion, and we know that with the help of the Fibonacci too. So obviously after an expansion we have a retracement before they continue in the same direction, if they want to continue in the same direction, right? Now do you see how this particular bearish fair value gap finds itself in a premium zone, right? So location matters. Please keep this at the back of your head, because that's very foundational for what we do as ICT traders, right? So you want to be taking our sales from this fair value gap, then we can make profits going lower. So that's basically how the fair value gap can support price action going lower, a bearish one to be specific, right? Now with that said, let's move on. Now the next thing we are going to be talking about are inverse fair value gaps, right? Now an inverse fair value gap, or short IFVG, occurs when an existing fair value gap fails and price trades through it, right? So that former imbalance can act as the opposing trade or the opposite trade. For example, let me give you an example here. First, let's get the illustration. So we have candlestick 1, 2, and 3. Now, see, because of time, I'm not going to draw the wicks. So we have candlestick 1, 2, and 3. Now between candlestick 1 and 3 we have what? A fair value gap. Let me make this a different color. Normally we expect price to retrace into this fair value gap like this and go lower. But in cases or scenarios where the higher time frame is switching, that means we are moving from a bearish scenario to a bullish scenario, they can inverse this particular fair value gap like this, then come back to that same fair value gap and use it as a reason to go higher. So this is what it's going to look like. This is what an inverse fair value gap means. So normally we expect price to go lower from this bearish fair value gap, but we inverse it and use it as a reason to go higher. And also it has to deal with the location the fair value gap found itself, right? So now let's go to the actual chart and let me show you where you can anticipate an inverse of a fair value gap. And it's pretty simple. When did I take this trade? On Wednesday, and I followed that particular narrative, right? Now look at what happened here. Let's look at this particular existing range, right? So from this particular low to this high is one range or an expansion. So let's mark it out. Now, do you see how this particular bullish fair value gap finds itself in a premium? Now, do you guys remember that when we find a bullish fair value gap in a discount, it's more potent? So if you find a bullish fair value gap in a discount, the probability that it will be inversed is high, right? So instead of supporting price higher, which it did here, price wanted to reverse because the higher time frame was changing, so they just inverse it and use it as a reason to go lower. So do you see how they disrespect it totally, come back into it and go lower again? So this is what the move is looking like. They disrespect, come back into it, and they went lower. So that's how inverse fair value gaps also work, right? So if you find a bearish fair value gap in a discount zone, the probability that it will be inversed will be high. So let's get that scenario too. Good. I have a very clear example here. So there's a bearish move. Let's mark it out from this high all the way to this low. Now we have premium and discount. Do you see how this fair value gap finds itself in a discount? So it was easily inversed. So you can see how we just inversed it. We ran through it, printed a wick into it, then went higher. So this is what they did here. They totally disrespected this fair value gap, came back into it, and what went higher. So that's how inverse fair value gaps also work. So anytime you are looking at a PDRA, you want to first of all ask yourself, what's the location of the PDRA in terms of premium and discounts, and what particular trend are they in? Are they in a bullish trend? Are they in a bearish? Are they in a retracement phase? Are they in a reversal phase? Now, inverse fair value gaps are mostly used for reversals, and normal fair value gaps, which is bullish and bearish fair value gaps, are mostly used for continuations, right? So in an expansion and retracement type of scenario, you are going to look for a bullish or bearish fair value gap depending on what you are looking at. And in a reversal case, you are going to look at an inverse fair value gap. Now, let's get into liquidity. There are two major sides, which is buy side or BSL and sell side or SSL liquidity, right? Now, buy side liquidity is generally found above obvious highs, right? Now, when we talk about obvious highs, we are thinking about equal highs, previous day highs, previous week highs, and major swing highs, right? So let's get to the daily time frame to explain what a daily high looks like. Now we're on the daily time frame. What that means is that every particular candlestick on this chart indicates a day of price action. So if you are talking about a daily high, we can choose this week, for example. Let's zoom in. So because we are on the daily chart, let's just zoom into this chart. Now this, whatever is above this particular wick is what we call a daily high or a buy side liquidity, right? So we can label BSL buy side liquidity. Now that's what a daily high looks like. Weekly highs too, we would have to move to the weekly time frame and the same. So let's drop down to our 3-minute time frame and let me continue what I'm explaining. So as I said, liquidity is generally found above obvious highs and obvious lows, right? So if it's below an obvious low, we have what we call a sell side liquidity, right? So if you realize, these markets always have bearish and bullish scenarios, and the reasoning behind that is that we can only do two things in the market: either buy or sell. Are you getting it? So you can either have only bullish and bearish scenarios or stuff, right? Then from here, there's an obvious high here, so obviously we have what we call buy side liquidity here, and that's pretty much it when it comes to buy side and sell side liquidity. Now, the important thing isn't simply identifying the liquidity, right? We want to understand how price interacts with it, right? So that brings us to what? Liquidity activation, and that's the last thing we have to do before this particular lesson ends. Now, let me get an illustration, right? Let me get an illustration on my chart first before we talk about it on the actual market. So let's get this down. So let's take this particular equal low like this. Then we know because it's below an obvious low, we have what we call sell side liquidity, right? So we have sell side here. I want to copy this and then duplicate. Then let me get another illustration for the bearish scenario. So because this is above an obvious high, we have what we call buy side liquidity, right? So we have buy side liquidity here. Then we also have, let me copy this and duplicate. Copy, duplicate. We have buy side liquidity here too. Yeah. Now, these are the types of liquidity activation. We can either have a liquidity sweep or a liquidity run, right? So for sell side liquidity scenario, let's look at this. A sweep will look like this. When they go below that particular low but fail to go lower and come back into the opposite direction. So what this looks like is a fake out. Retail logic, support and resistance, we call this a fake out. So they trick sellers into thinking that we want to continue lower, then they sweep the liquidity and go higher. Now the second type of liquidity activation is what we call a liquidity run. That's when they actually want to go lower, so they run the liquidity and stay lower. So this for sell side liquidity activation. Buy side will look the same but in the opposite direction. So liquidity sweep on the buy side will look like this. They go above the high, fail to continue higher and come back into the range and continue bearish. Then buy side liquidity runs will look like this. They go higher after running the liquidity. So that's that for liquidity activation too. Now, under liquidity activation, there's one thing that is key, right? Now, we don't buy simply because liquidity was taken. We actually wait for evidence. If price sweeps the lows and gains aggressive displacement higher, that's telling us something. So in a liquidity sweep, price is sweeping the sell side liquidity and they are displacing higher. What is that telling us? Do you want to continue higher? So from there, we can look for a retracement into a bullish PDRE, then we continue higher. Now, I'm just giving you what to look at because in the next video I'll be talking more about how to use all these concepts to look at a trade, right? Now I'm putting it all together, right? We're about to connect everything we've talked about. Think about this market as a sequence, right? Now liquidity gives us objective, right? Displacement gives us information about the intent, like where they want to go next. The PDREs give us potential areas for price to retrace to. So instead of randomly trading every fair value gap or order block you see, we are waiting for prices to align or pieces to align together, right? So for example, price takes a sell side liquidity, we get a bullish displacement, then that bullish displacement, let's say, creates a fair value gap, right? Now let me take this off. That bullish displacement creates a fair value gap. What's the next thing we are looking for? A retracement into this particular fair value gap. Then we continue higher. Now this can also be looked at with the Fibonacci. So where was that bullish fair value gap? In a discount. So do we see how everything is coming in play? We are building on the knowledge. We are seeing how all these various parts are coming together. Now this can also be seen from a bearish scenario. So this will just look in the opposite direction. So now let's recap. PDREs give us areas of interest. Order blocks show us areas associated with significant displacement, and FVGs show imbalance. Now with IFVGs too, they show when that imbalance fails to do its original role. So its role can be flipped into a different one. So if you are having a reversal, for example, if a bearish fair value gap finds itself in a discount, just like this bearish fair value gap is finding itself in the discount of this range, look at how they just invert it and go higher. So that's one thing to look at. Then buy side and sell side liquidity shows us where liquidity is resting or maybe located, right? So one thing you also want to remember is you don't trade the concept, you actually trade the context, right? What that simply means is that all these concepts may sound fun, may sound intriguing, you're learning something new. It's not about the concept, it's about the context that concept forms in. I don't know if I'm making sense. Now in the next lesson, we are going to take this concept directly to the chart and break down how they appear in real market conditions, right? So with that being said, thank you for your audience. I'll see you guys later.